Welcome back, everybody, to our weekly update on what's going on in the markets. And thank you, everyone, for attending. We're going to get started. As I see most people have logged in, probably a few more popping in along the way, but that's okay. We'll get moving here. As usual, my name is Michael LeBlanc. I'm Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. I'll be your host of these weekly updates. And thank you everyone who's been attending and the feedback we've been receiving. Really appreciate it. It's been a great way to connect with people and get information out there on an efficient basis, even if you're watching the replays. Obviously, we try to keep these as current as possible. And it's also nice for me to talk to other people, given that we're all quarantined, even though I'm quarantined with the family. The kids were having a big discussion yesterday about grooming, having to cut their hair, and I tried to chime in, and for some reason my opinion wasn't taken seriously. So it's nice to talk about something that people at least listen to me and hopefully value my opinion a little bit. As usual, disclaimers, the information we're showing here today is as up to date as we can get it. Some of the charts you'll see are from late last week, and things have obviously changed a little bit yesterday and today. And I'll talk to those changes, but we do try to keep the information as up to date as possible. And as always, this is general information. Your specific situation, obviously, do seek advice specifically about your situation. Feel free to ask questions or reach out to your advisor or to us by email or phone, and we'll happily answer any of those questions for you. So just on the technology front, if you do have a question, if you move your mouse around at the bottom of the screen, you will be able to bring up the toolbar, which allows you to type in a question. Your toolbar should be somewhere around down here, and the little box that says Q&A. We are using the Zoom technology. So a couple of things. One, you're all muted right now. It's a default setting on our version. And your cameras are all off, so you don't have to worry about you popping up or anything that you're doing on your computer. It's not going to pop up, or anything that's going on your screen won't pop up. We do have the paid version, the more advanced version of Zoom. I know it's been in the press quite a bit around some privacy issues. Most of those are around the settings that people have been using, and also the free version. Where it's open and it's limited to 40 minutes. You cannot do a webinar on those versions. So we do have the corporate version that has built-in security. So we're very confident in what we're presenting here. And as I mentioned, no one can pop in or take control of it other than myself, unless I give them permission. So we shouldn't have any of those issues while in any of our webinars. So let's get into it today. I always like to mention, special thanks to everyone out there who's helping us get through this, whether it be doctors, nurses, delivery people, grocery store, truck drivers, first responders. There's so many people working very hard. Some that we probably never even know about are working very hard to keep things moving, keep us fed, keep us with the supply chains open, and just keep our life as normal as possible during the quarantines. So thank you to them. And I do highlight the food banks, as I know they're in special needs right now. That being said, if you can help in any way to any of the charities, they're all suffering right now due to funding. And obviously a higher demand on them, maybe a local charity in your community or some of the bigger, broader ones. If you're not sure where to help, then you can allow them to make the decisions. Do keep that in mind. There are a lot of people still in need out there, so I do like to highlight that every week. Oops, here I'm playing with the technology here. I apologize. I need one of my kids here to help. All right, let's get moving. So every week we go through these three parts of the agenda. One, where are we at with COVID-19, where the markets are today, where we see things, and then what's coming up next. So we'll dive right into where we are today. Of course, the theme is COVID-19. It's the quarantine. Pretty much for the next foreseeable future, we're going to be talking about COVID. Although that doesn't mean the news hasn't changed. We're not reiterating exactly what we said last week. There's new things coming out every day, new economic signals, which we're really going to dive to in part 2 of today's webinar, and just try to keep everyone up to date on the information that's flowing. There is a lot of information out there. I do recommend people get out a little bit. I mean, I'm fortunate. I live in the North Shore here, where there's our yard is beside a creek and trails. Maybe not official trails, but we can get out into nature a little bit. But try to get away from the news. One of the hazards of my work or our industry is that we're trying to stay on top of all this. But there is a lot of negativity sometimes in the news. There's also a lot of good things, which we're going to touch on today. But do try to get out and move away from the news cycle a little bit, because I know it can weigh on our psyche a little bit, just constantly hearing that things are bleak. And it's not all bleak, luckily, but we will get into that a little bit more. We will try to keep everything with the latest. Obviously, we're seeing Italy and Spain. Despite how severe their outbreaks are, they are managing the outbreak and even peaking. So we'll see some of those in the charts today. So understand what's going on. I'm going to shrink my face here a little bit just so that we can see the screen. I'll pop it up when necessary. But what's going on out there today? We've been about a month into this. This is our 4th week of doing this update. So it's been about a month. Still the big what if is the exit strategy, and I'm going to dive into that in more details. But just to focus on the virus itself and its rapid spread, it has been decelerated. I know these numbers are then from last week. That's the latest graphs that we have out, but I will show the live numbers from this morning at the end of this part, just to give you an update. But it is flattening out. It looks like it is peaking. The economic news, though, we're still seeing a lot of negativity potential coming through. But as far as the virus goes, it does seem to be slowing a bit. And if we look at China in some ways being the epicenter, it seems so long ago that we were talking about the China outbreak and how quickly it was going. And now we've been talking about Europe and, of course, the United States being the focus of the trends these days. But we do see some positivity coming out of China. We'll dive into those numbers. But as you can see, the spread is slowing. You can see the bar chart of the numbers, daily numbers are decreasing. And also that spread line, the transmission line, is slowing around the world. What does that mean for the individual countries, the transmission rate? The goal is to get the transmission rate below 1. That suggests that the transmission rate is not growing, according to this chart here. As you can see, some countries are still above 1. The world is still slightly above 1, but it is coming down. More and more countries are falling below there. And US, which is the one we're really watching, being the largest economy currently, in the middle of their cycle, or hopefully peaking in their cycle very shortly. But that's one we're watching there, and you can see they're just above 1. The U.S. quarantine response has been working. These charts here don't necessarily show all the current data, but one thing we have seen, especially in hotspots like New York, it does seem to be peaking a little bit, which is positive. They have been doing more and more quarantine. It has been working. Things like California, and as I mentioned, New York, the quarantine efforts have been working. I don't think we can ease up on them quite yet. We'll see a lot more about that in the news in the coming weeks. But it is working. Spain's another one where we're seeing it was a very harsh outbreak, but you can see those transmission numbers falling. Also, the number of infected cases are fallen as far as the daily rate. Those are positive, not out of the woods yet, but very positive that we're starting to see that even in hardest hit countries like Spain and Italy, where they're falling off. Most of the news cases are asymptomatic, and that's of course pass between people who are not showing signs of the disease yet, as opposed to the personal contact with someone who's already showing signs and infected. China's economy is a big part we're going to talk about today, in the fact that it is rebounding. We'll have some discussions around their numbers, but we are seeing things opening up a little bit in the US, or sorry, in China, and that is a very positive signal. Relative to China and Europe, North America's quarantine has been a lot more loose. People are still out and about. I happened to be out for a drive the other day, and I couldn't figure out why traffic was lined up in the right-hand lane along Hastings, and realized people were waiting to get through a Starbucks drive-through, and it was lined up. It had to be 30 or 40 cars. Dog walking is still very active. Pickup and takeout food is still very active in North America. So North America's quarantine is very different from what we've seen in Europe and China. We haven't actually had the severe lockdown, and we might not have to because ours started earlier, and people seem to be taking, for the most part, people taking the self-distancing or social distancing a little more seriously and a little earlier than they did over there. So we might not get into that full lockdown measures here in North America. Real-time economics is something we're really going to dive into, and you're going to hear more and more every week. And that's what we really have to watch, is where the damage is happening. Sometimes when we talk about economic indicators, the problem with them is that they're already past. We've already gone through, for example, recession. The real indicator for recession is 2 quarters of negative gross domestic product, or GDP growth. And of course, that means you're 6 months into the recession by the time you officially call a recession. So what we're really trying to watch is some of the real-time economic indicators telling us what's going on. And obviously the latest ones we're watching is the job loss claims, which have been massive. We're watching credit usage. Now, this is not the number of times people are using their credit cards, but the total dollar is way down. People, whether they're unemployed or uncertain, they're not spending as many dollars, which might be a good thing to help us get out of this, but does indicate that the economy is going to suffer from those lack of sales. Certainly in specific areas like restaurants and so forth are going to be impacted a lot more. So we're watching a lot of technology-based indicators that give us real-time information. We're still hearing predictions of about 100,000 deaths in the United States. Actually, yesterday and today, some of the experts have actually started to lower that number as a possibility. One of the big dangers is the US is currently on that tipping point of do you ease up or do you not ease up on the quarantines. It's just one of those situations where, I was thinking about it the other day. It's kind of like teaching my kids how to ride a bike. You're holding the back seat, they're pedaling along. If you let go too early, they might fly right into the hedges. If you hold on too long, they're going to turn around and say, "Dad, I can do it." Neither one of those are good for me, but it's the same place we're at right now when it comes to the quarantine. We're in a spot where it's going to be very iffy as to how much and how soon we lift that quarantine, and whether we can really flatten that curve and really keep the epidemic contained, especially with the number of deaths, and keeping the hospitals not overwhelmed. We don't want to get into another New York situation, but we are still seeing some hot spots in the United States, so certainly not out of the woods, but hopefully some clarity. The exit strategy, it's going to be difficult. We're going to dive into some what-if scenarios here today, but as we start thinking about coming out of this quarantine, what does it mean? Are there going to be some more road cases? Are there going to be more flare-ups? We're all seeing in South Korea, there's some potential of reinfection for people who have already had it. So there's going to be very difficult and cautious steps. We're keeping a very close eye on that. And even once the economy starts to recover, it's going to be unrealistic for everything to just snap back the way it was. There's going to be real economic damage, and especially in certain sectors. The business cycle has been disrupted. So where's the new business cycle going to start? What's going to be the starting point? and how long is that going to start or take to really rev up again? All those things are going to be questions that are going to continue to be asked as we go through the next few weeks of data that's coming out. So for all that bad news, a little bit of talking about the U.S. As I mentioned, this chart's from last week, but we do see that the daily rate kind of falling off a little bit. It does go up and down, but in the last few days, it does seem things have been getting a bit better. Washington State, which was one of the first communities to hit, has certainly looks like it's peaked and calming down. New York City in the last couple of days, the numbers have been a bit more positive. That it looks like they're potentially peaking and flattening off, which is really good news for New York. Obviously, it was one of the hardest hit. But as I mentioned, there are a couple more flare-ups happening in other states that weren't as quick to shut down, and may become a New York situation again, depending on the next couple of weeks. The different areas that did lock down first, obviously, are going to emerge out of the quarantine before others. But we're going to have to really watch what the government down there is doing to stay on top of this. Testing obviously is going to be a big issue to come out of this, and we're watching what the different governments are doing there. Bear with me here. There we go. The virus itself, well, it maintains the subject of the day. All the news, everything out there is going. We're still at a very high rate in the world today. The test, good news on the test, a new test has just been approved that has a 15-minute result. In fact, it's being manufactured here in Canada, and obviously other places in the world has been licensed to produce it. That's going to be very, very important, not just to have more accurate tracks of where we are in the curves, but also when we can come out of this. Because when we do start to come out of this, having an effective immediate test is going to be very important to limit those who are still showing signs, are still infected, from intermingling with the public as we start to open things up. So that's very good news on that front, and we've seen that. Conversely, on the false positive rate, healthy people have been told they're infected is basically zero. So that's good. We have seen some people that have been false positive on the other side, but nothing there. There was news out in the Bronx Zoo that some tigers were infected. I have to admit, when I saw this on the news, I thought it was something about the Tiger King, the Netflix series, which, if you haven't watched it, is as crazy as the world is today. So is that show. So something to entertain yourself, maybe as a distraction. I don't recommend it as high quality media, but it is certainly distracting. That being said, there is a lot of concern around animal to human infection, especially with our pets. Dogs obviously being very on the forefront of the news, because in Hong Kong there were a couple of dogs that were reported infected. Obviously, with the limited testing, there's not much work being done with animals right now. Most of the testing is focused on people, but it is something to be cautious about. So if you're out with your pet or dog walking, cautious of other people petting them. There's still not a lot of data, or not a lot of reliable data, as to if it can be transmitted by touch with animals, or if it stays on their fur for any amount of time. So keep that in mind when you're out there. Do keep the social distance with your pets as well, or with other people with your pets as well, just to ensure that we don't continue the outbreak that way. Obviously, in the news, there's a lot around the pharmaceutical companies who are working very hard to come up with a therapeutic, so a treatment for COVID. There's been some talk of the hydroxychloroquine, or its brand name Plaquenil. Although Brazil, who started a live test on people, have just stopped the test after having 11 deaths while on the drug. So we're not sure where that one's at, but there are several other ones that are being tested, and hopefully we will have a treatment, at least in the shorter term, that will really help with the the next step, going reintroducing people back to normal society. Today, this is as of this morning. Sorry, at the bottom of the chart there, I didn't update the date, but that was as of about 10 o'clock this morning. We have the world just shy of 2 million total cases and about 123,000 plus deaths. And the US, as I mentioned, we're watching very closely. They're just approaching the 25,000 mark. And hopefully we can start to see the daily numbers start to drop across the board. Spain and Italy have already started to drop. Obviously, there's still increases, but at a much lower rate. France has spiked quite a bit, but again, they do seem to be slowing. Germany doing quite well overall. Obviously, the infection is spreading, but they managed to flatten their curve so far to the point that they're able to treat as many people and prevent the excess deaths. So that's very positive. Canada, we're seeing some growth numbers, mostly in the east. The west seems to be doing well, and hopefully that continues. And hopefully the east can slow things down a bit more. So where are we at today? The big thing that is impacting today's markets is the stimulus measures we're seeing out there. Here you can see the different stimulus packages that the world countries have put out. The U.S., percentage of spending that they've done or that they've approved. Just that first column there, the asset purchase, and that's basically keeping the banks liquid, keeping companies' debts liquid. So they've opened up the vaults and basically said it's unlimited. They'll spend as much as possible. That's actually a very significant development last week, because we did not see that happen in 08, 09 right away. It took some time. And in fact, if we look to Europe, one of the big turning points for Europe in the crisis was around the UK and the EU basically saying, we're going to make it unlimited. We're going to make sure that the financial institutions stay solvent and stay liquid, meaning they'll be able to finance it and continue to fund the economy even in hard times. So that actually is a very big impact that they did that early into the crisis. Canada's done the same. The EU, the ECB there, you see 7.3% of GDP is their cap on that so far. They obviously have room to move with that, and they very likely will have to. But keep in mind, the EU is very different than the US and Canada because they have to have a majority. They need to have everyone to agree, all the different countries to agree to any policy they put in place. So it's a little slower to move, which will actually strap their recovery. Their economic recovery will slow a little bit because not all countries are going to be dealing with the same situation. Obviously, with Italy and Spain being hit so hard, they might have different needs than Germany, and there's going to be some back and forth as to what they do and how quickly they do it. So do be very cautious around the European Union as far as investing goes, just because they might be a little slower to come out. As far as the fiscal stimulus, you can see how much GDP has been currently spent, both in stimulus and relief packaging, and we'll expect those numbers to change as we go along. Other countries around the world are doing the same at different rates. UK obviously being very aggressive, and some of the smaller countries haven't had to yet, but we'll probably see those numbers move quite a bit as we move through this crisis. Highlights of some announced actions. As I mentioned, the U.S. Fed, shot their bazooka. They've really brought a big relief to the credit markets out there by basically saying that they're going out and securing and buying up treasury mortgages, bonds, just to keep everything liquid. Canada's started to do the same, spend a lot of money. Obviously, there's more problems showing up. We're seeing, the mayor of Vancouver this week, I think it was this week, coming out and saying that they need a bailout from the province, potentially facing bankruptcy. If you had followed prior to COVID, Newfoundland was very concerned around bankruptcy, and Ontario as well had gone into a very aggressive budget cut-in with their premier, Doug Ford. Prior to COVID, and of course they've had to spend a lot of money during this process to try to shore up the people and also the economy, and where that's going to leave them when we come out of this, or even while we're in the middle of this. So the Bank of Canada has freed up a lot of funds and are actively out there, which is going to help with the recovery. How much will depend on how long we're in there. The central bank has started doing quantitative easing as well. They still have more room to move, as I mentioned, as well as the Bank of England. Just to keep things in perspective, the U.S. is spending about $1 trillion a month at the current rate. So we'll have to see where that ends, because that's a lot of money being spent and a lot of money being printed. The Fed has printed almost $4 trillion to date. I think I already have a question about that. Where does that leave us, and where does that leave currencies compared to other countries? And that's a big unknown at this point, because as we're printing currency, of course, that is an inflationary action. And it's going to depend, because our currencies are basically pegged to other countries, not to, say, the gold standard as previous year in history. It is all going to depend how other countries fund this, whether they print money, whether through interest rate cuts, and so forth. So far, we've seen some impact to the Canadian dollar. Most of that's been from the oil pricing, not really on our currency, because we're pegged mostly to the US dollar, who've been printing a lot. So we're going to have to watch that very closely as those data numbers come in. So there's not an immediate answer to that, but certainly there is going to be some effect around the world to all currencies as the governments take these very aggressive actions. Sorry, there we go. Some highlights of some of the announcements. The central bank has basically cut lending rate to zero. Both the U.S., Canada have done the same. We're very low. So there's not much wiggle room left there. All of these are other means that they can use, such as quantitative easing that they can do, more printing money. We're already basically at the level that we did at the peak of quantitative easing in 2009. So we haven't really surpassed that, but we're pretty much at that level. So that's how aggressive the governments have been. And a lot of that has been learned from what went right and what went wrong in 08, 09. So these may actually help curb things quite nicely. The US, as we talked about, has had that huge response. They're already at 11% of GDP in some spending areas. This large-scale package is really working from country to country. It's a theme that's emerging across all governments, and everyone's trying to get to the same place, is to keep the economy rolling. The first phase has been targeted as emergency programs, whether it be the testing, hospitals, equipment, and then now what we're seeing is the rollout of phase two. In Canada, the US has been a little slow in getting there out, and that's the stimulus to the workers who have been sidelined, the unemployment. The companies who are really being encouraged by the governments to keep the workers on the payroll, and we've actually seen some companies, Air Canada, WestJet, who initially laid off workers in the tens of thousands, and have brought many of them back under the program where the government is supported 75% of the pay, which is good, because that will, having workers still on the payroll will speed up the recovery, because to have to bring people back, how fast the companies would do that, depending on their revenue stream as they start going, could take more time. If they're already in the payroll, it should ignite things to come back much faster. So from a lot of sense, that those efforts are going to pay off. The bottom line is the economy is, we do not know where the economy is going to end up here. There's a very good news last week we saw in the markets. We saw the economy the markets in Canada bounce back almost 9.5% in a relief rally, which is a good sign. That means there's money on the sidelines willing to deploy. So that should not be discounted in any way. However, it should be taken with a huge grain of salt, in the sense that it just shouldn't have. There's almost 10% growth from the lows in the market. We have not seen anything in the economy that would indicate that things are coming close to where they were when we started entering into the shutdown. So we'll dive more into it now, like what's next, but really keep an eye on those relief rallies. I do think I've mentioned in previous weeks, we are looking for another pullback, possibly retesting the low or close to the low. And that should be a signal to start wading in to the markets, into key positions, into key sectors. No sector is going to walk away unscathed. Other sectors are going to walk away in better shape. And some sectors are going to be in a better position to ramp up their revenues much quicker because they didn't completely shut down. Others are going to take a lot of time. So let's keep a very close eye on that. Just to see what that looks like, the reopening. China has started to reopen. There is a lot of question around the Chinese data. Obviously, the US and the UK have been questioning their infected rates and total cases. What it seems that it's come down to is that China was not counting asymptomatic cases, so those transmitted by people who were not infected. Now they are, or now they say they are. So the new data coming out is potentially more accurate. The old data not necessarily as much. But what we're really watching is the economic data as they start to reopen. This is what will give us some insight into what ours will look like. And it actually looks like the data is coming out fairly accurately. There is a index, a combined index from a lot of different data sources that we track to mimic what's going on in the Chinese economy, because not all the data is, even in normal situations, not all the data is necessarily clear or trusted coming from the government. But it does seem to be matching exact numbers that they've been putting out, which historically has not been the case. So we do see the big sharp decline in 2020 when they did all the big shutdowns, and we are seeing that number starting to lift. So that's going to be an important indicator that we're going to keep an eye on, is to see how quickly we can see our economies to start to pick up again after things open up and we get back online. So the exit strategy, this is what's coming next for us is, let's say the curve has flattened and we are peaking, and we're going to start to come out of this in the coming weeks, months. Trudeau this morning used the word weeks before we stopped the quarantine, which sounds like a long time, but it's better than months. And it's also better than, people were talking about into September or later into the year. So the word weeks is very positive, that we could be weeks away from a slow start to opening up. But the first thing we have to do is get it under control. And we're definitely in that area. As I said, we're at a very sharp tipping point as to when we start to slowly open versus potential a new peak. So that's going to be something we're going to watch from week to week now very, very closely. Step 2 is going to be the partial reopening. So what is that going to look like? And that's going to be very difficult to tell at this point. But continued physical distance, obviously protecting the elderly or the more at risk. Testing is going to be a massive of importance in this partial reopening, whether it's going to be taking your temperature before you go into stores or into work, or even that new 15-minute test might be something that's going to be required for different employment or different areas of much more physical contact, whether it just be the medical staff or the frontline people. But there's testing, being able to provide a very efficient and fast turnaround test is vital to this process. China has started some significant restarts, but it's still in step. They haven't opened everything. Some areas are still in full lockdown, and they're doing so without that therapeutic drug or without that treatment. And hopefully by the time we get there, there will be at least some sort of treatment process. And I think that's why you're seeing the treatment rates or the recovery rates in North America be a bit better than Europe and China, simply because we've learned a little bit from their processes, what's worked, what's not worked, getting people on those ventilators faster. So all those different things are going to help with the reopening of the economy. It's been proposed it's going to go by region which areas are more dense, which areas have had bigger concentration of cases, local conditions. Everything's going to come into play when we start to reopen. Age and health status may come into play. The elderly may be limited or asked to continue to quarantine. If you're a high-risk health status, you may be asked to continue to quarantine. Or, as we've already seen, some stores or some areas, and we've seen the grocery stores and the pharmacies having specific hours for the elderly or for those who are immune compromised to go in when the broader public's not in there, just so that they can get access or start to open up again without being put at high risk. We're going to have to watch very closely whether people have already been infected and recovered. The mass immunity, the herd immunity. But again, there's still a bit of data to come out on that front, as we're seeing in South Korea, that it does look like some people are being reinfected, but we don't have confirmation of that data and what that looks like. So that might be part of it. It may not. We'll have to wait on that data. And then maybe expanding what's constituted as essential services. So slowly open in different industries, slowly open in different sectors, and seeing how that evolves. Step 3 will be the full reopening and physical, without physical distancing. So being able to shake hands with people, sit down and having some social contact. That's going to take a while, obviously, not only from us being able to treat or get things in control. Maybe an outright vaccine before we get to step 3 has to be available. And there's also going to need the society's acceptance. A lot of people, in chatter in the news talking about the handshake's gone. Like, we'll never get back to handshakes. We'll have different ways to greet people. I don't know if we'll get to that point, but I do think things are going to change in society as we come out to get to step 3. And step 4 is really the next pandemic. This is not something that just came out of nowhere. Obviously, there's been other ones. We've had SARS, MERS, H1N1, Spanish flu, obviously much longer ago. But as the world becomes more and more global, we will be facing this again. So what are governments and what is the economy going to do to shift to make sure we're better prepared for the next one, so we don't get into this place, or we have more certainty when we get close to that as to what steps we need to do. So there will be a lot of change in that, and economic observations around this. In the previous weeks, I've talked a lot about being very careful as to what sectors we move into when we do start to come out of this. Making sure, which sector is going to recover more quickly. But some things to keep in mind is when we go through big changes like this, and just put this into context, we've had complete industries shut down. And the governments around the world spending a lot of money and are going to spend a lot more money to restart the economy. Where are they going to focus those funds? And Canada is an actually interesting model, and we've seen this come up many times. The oil industry, the energy industry. This is an industry that's been under a lot of pressure in the last 5 years, even the last couple of years, about more clean energy or the climate. So Canada is going to be faced through this crisis. Is going to be faced. Do we put billions of dollars behind trying to revive the oil industry and those jobs, or do they put those billions of dollars behind a new technology, a new cleaner energy, created all new jobs, a whole new industry for Canada to come out of this? And I don't know the answer, and I don't know what the right answer is. But that's something to keep in mind, and governments and even businesses, as they restart and they know they're going to have to invest money to get things going again, get their revenues back up. This is going to be a catalyst of change on many different levels as to where we come out of this, what industries are going to become most profitable the quickest as we come out of here? And do we lose some industries, or do they shrink even further because of this change? So that's where we're really, really watching the data. The jobless market is an example. Where do these people get rehired? March payroll numbers, again, this is a backwards looking indicator, fell by about 700,000 in the US. And that was just March. We've already seen in the US in April, jobless claims spiked by 9.5 million over normal rates just in the past 2 weeks. So, the April jobless numbers is going to be potentially a very, very shocking number. And that's why I think that relief rally we're seeing in the markets last week specifically as being a little bit too soon. There's still a lot of economic impact out there that hasn't translated into the markets. And I'd be very, very surprised that any of that rally can hold, given we haven't even seen the real earning hits that companies are coming out. Governments are coming out with it. I mean, look at the city of Vancouver talking about losing $180 million already. SkyTrain or TransLink is talking about 70 million in losses. And these aren't companies. These aren't companies that rely. These are government-funded institutions. They're not companies out there who have had total shutdown of revenue and customers, and still try to keep the doors open. So the global recession is very likely here. And the backwards looking indicators are not going to help us. We have to really look at the real-time indicators and adjust. Some industries like restaurants and theater bookings obviously are at zero, and where do they go from today? So I don't have any specific recommendations today. We did have some last week, and the reason being is because we're seeing new data all the time. Plus, I had a few people kind of come out saying that they want to go start buying some of those recommendations. As I said, I'm not really a proponent of buying into the rally. In fact, I might even look at selling into the rally as opposed to thinking that this is going to hold. Always stick to your plan. I say this every week. Stick to your original plan. Stick to your risk factors. That doesn't mean stick to your positions. As this data comes out, sell any at-risk positions, create cash, sell into these rallies, take the opportunity to move cash out of positions that have bounced back, maybe unwarranted bounce back, but have come back. Take that cash and really look at the long-term process that you have in your portfolios. Look in the long-term buy-in strategies. So a lot of long-term conversations long conversations I've had with people is really look at companies' cash flows. How much have they been impacted? How long is it going to take them to restart them? There is no companies that have not been impacted. It's really how quickly they can restart them. And that will be determined basically on how much they've been hit. So total shutdown is going to take longer to restart than people have kept revenues going, such as the grocery stores, the transport companies. We've been through these electrical companies. We've mentioned them in previous weeks. Their revenues are going to fall a little bit, but they continue and they will bounce back a lot faster. As always, just a little bit about Canaccord in the slides. We are an international firm. We're drawing our data from around the world. We're getting live data out of our European offices, Australia and Canada. We do have offices all through the US as well on the corporate side, which allows us to stay on top of this. So I thank all of them for working diligently from home and many, 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 many FaceTime meetings. Some questions. So one of the questions is the IMF predicted that this is the worst recession since the Great Depression. That's been echoed a few times. And again, yes, it could be. The Great Depression is going to be one of the things we can't tell is how long this is going to last. And that was what the big thing about the Great Depression. It wasn't how much things came down, it's how long it lasted. And that's what is the real unknown, because we don't know when we're going to come out of, first of all, the quarantine, and how long it's going to take to get everything back to normal, get back to that phase 3. So to call it the Great Depression might be a little aggressive right now. It's certainly something to keep in mind. And then also during the Great Depression, again, there was a lot of fortunes made. So the last part of that question is how will it affect our portfolios? There was a lot of money made coming out of the Great Depression, because of course things got so cheap. There were some industries that started to grow and boom through that, and that's the real opportunity during these periods. And that's why people have heard me say it before: cash is king. Having cash available. We have recommended to a lot of people. One of the stimulus package, part of the stimulus package is that if you are in retirement, the government has eased the requirements to pull out of your RIF a little bit. That's not to say you shouldn't keep living or you should scrimp and save, but if you have excess income, if you're planning on a trip this year that you're not using the money for, do keep that in your portfolio, because that cash is going to help your portfolio rebound even faster. And the second part to that is really what's in the portfolio. As I've talked about in previous weeks, our portfolios, we've really focused on those, I want to say, defensive positions, the areas that continue even during a recession. So the power, the grocery stores, the non-discretionary goods. One thing we're working on preparing right now, because I've been asked so many times, is a list of discretionary spending items, such as the travel industry, whether it be cruise lines, airlines, hotels. If you wanted to take the big risk, which ones are the best out of those? So we are working on some data to try to put together the best of the worst list. That being said, those are going to be the longer ones to come out of it. So as far as how the portfolios are being affected, I still see the opportunity for the portfolios to bounce back much quicker than the economy. Those are two different numbers. The economy and the broad markets, the TSX or the Dow Jones or even S&P, are very different than a portfolio. A portfolio doesn't have to be in all those areas. The S&P is almost 52% oil and gas. Your portfolio obviously is not, if you're with me, but doesn't need to be. So your recovery doesn't have to last that long. In fact, the Great Depression, the Rockefellers made billions during that in oil, because that was something that recovered. There will be areas in the markets and in the portfolios that are going to do much better, much sooner than the broader markets. So long-winded answer. Could it be as bad as the Depression? We won't know for quite some time, how long this is look like it's going to last. But that doesn't mean that the portfolios are going to suffer for that long. So there is opportunity in there. The other question I have here is, if they print more money, they don't owe anyone at the end of the day. Kind of true. If we print a lot of money, does Canada owe anyone? Not necessarily, but it does cause hyperinflation. So, some examples of this was in the 90s, or late 80s and 90s. Mexico went through this. And I think, I can't remember now exactly, but I think it was 94 that the peso had to be rolled back 1,000 to 1. So for every 1,000 pesos, you got one new peso because of hyperinflation. So you can imagine $1 Canadian was worth, I think it was somewhere around 100,000 or in the tens of thousands anyway of pesos. So they had to roll it back. And we also saw Russia do that in previous years. More recently, Iceland, hyperinflated when they declared bankruptcy in 08-09. So it's not a good thing to continue to print money. The only thing that will help us as far as the printing money, as I mentioned, other countries are also printing money, which, because we're pegged to other currencies, it will slow the inflation effect. That being said, inflation is going to be something to be very, very cautious about when we start to come out of this. How quickly do we remove that quantitative ease, and how quickly do we remove excess currency out of the market compared to other countries? So it is a danger, and we'll continue to do that. I think from a timing perspective, I'm right on the mark. A couple more questions were all around the same topic, so I think I've covered those. But by all means, if you have some more questions or you want to ask some specific questions on your situation, feel free to reach out. We're available email, phone, and we're always around to answer those. If you're watching this on the replay, same thing. Just email us or call us with any of your questions. We're happy to answer those. And as always, feel free to share this and online. I noticed last week our LinkedIn posting of this got 400 clicks. So obviously there's a lot of interest. We're going to continue that. I am not going to start my beauty haircut and tip webinars weekly, but we will continue this one. So thank you everyone who's been with us for the last few weeks. We will definitely see you next week. And if anything comes up in the meantime, happy to talk further. Thank you all and take care.